Remember in Module 1, we said that the goal of managers is to maximize the shareholders' wealth. How can they do that? By maximizing the value of the firm. Therefore, the managers must choose the optimal capital structure, that is, the right mix between debt and equity that will maximize the shareholders' wealth. How do we know managers maximize shareholders' wealth? The value of the firm will increase. How do we increase the value of the firm? One way is to decrease or minimize the WACC, the cost of capital. Remember that the cost of capital, WACC, is the appropriate discount rate for the firm's assets. We can find the value of the firm by discounting the firm's expected future cash flows at a discount rate. The process is the same as finding the value of anything else. Since value and discount rates move in opposite directions, firm value will be maximized when WACC is minimized. And that's what the rest of the module deals with, finding the best mix of debt and equity that will give the lowest value of WACC and the highest value of the firm. Again, in Module 1, we said that corporate finance deals with three major decisions: capital budgeting, capital structure, and dividend decision. Any decision about the mix between debt and equity falls under the capital structure decision. When a firm relies more heavily on debt financing, it's said to employ more leverage. And we call it capital restructuring when the firm alters the debt to equity ratio without affecting the value of the assets. How can the firm do that? Two ways. Either increase the leverage by issuing debt, such bonds, and with the money from the issue repurchase equity, such as shares. Or the other way, decrease the leverage by issuing equity, such shares, and with the money pay off some debt, some loans. If we look at two variables of interest for shareholders, earnings per share and return on equity, we can see how debt affects each of them. When we increase the amount of debt financing, we increase the fixed expense, which will affect the net income, the key variable in earnings per share and return on equity. If we have a really good year and make a lot of profit, then we pay out fixed costs and we have a lot left over to distribute to our shareholders. Earnings per share and ROE increase. If we have a really bad year, we still have to pay the interest for our debt, irrespective that the firm has low income. Therefore, in the end, we have less left over for our shareholders. Earnings per share and return on equity decrease. We see that leverage can dramatically alter the payoffs to shareholders by causing variation in earnings per share and ROE. Let's look at this example. High-Tech Manufacturing Corporation, HTMC, is an all-equity company with 200,000 shares outstanding. HTMC has no debt. We call it unleveraged. And the HTMC's Chief Financial Officer is considering changing the capital structure to 50% equity and 50% debt to make it leveraged. The proposal to issue $5 million in debt at 6% interest is to buy back 100,000 shares at $50 per share. The assets will be the same, debt will increase and equity will decrease. How will this affect the return on equity and earnings per share? If we look at the top right table, currently with no debt, there is no interest, and that's how much net income, return on equity, and earnings per share the firm will have in various scenarios of economic conditions. If we introduce debt to equity ratio becomes 1, as we have an equal proportion of debt and equity. So if we have debt, also we have interest expense, as shown in the right side bottom table. However, except in recession, we see that by introducing debt, return on equity and earnings per share increase. We conclude that the effect of leverage is beneficial when earnings are relatively high. At the same time, shareholders are exposed to more risk because earnings per share and return on equity are more sensitive to changes in earnings depending on the economic conditions. To avoid exposing shareholders to more risk, financial managers monitor the effect of leverage on earnings. One way to examine the effect of leverage is to look at the earnings before interest and tax and calculate the break-even EBIT. At that level, the earnings per share is the same whether the firm has debt or not. Therefore, if managers expect future earnings to be greater than this break-even point, the leverage is beneficial to the shareholders. They will receive more earnings per share. And if the expected earnings are less than the break-even point, leverage will cause lower returns to our shareholders. And this is the graph which shows that above the break-even point, where the two lines cross, that is the break-even point. So above that point, financial leverage is actually improving the returns to shareholders. So we see the red line is above the blue line on the right-hand side of the crossover. But below the break-even point, financial leverage or introducing debt has its disadvantages to shareholders as it reduces the earnings per share. That is to the left of the crossover point of the graph. So if the management goes ahead with the proposed scenario and introduce debt, they must keep the earnings above this crossover point. What can we say about leverage then? The effect of leverage depends on earnings, depends on this level of EBIT, earnings before interest and tax. Leverage increases shareholder returns, return on equity and earnings per share, when and only when EBIT is greater than the break-even point, is greater than this crossover point of the two scenarios. Also, the variability of return on equity and earnings per share increases as we increase leverage. The slope of debt is steeper than the slope without debt. So the red line is steeper than the blue line. That means it's more variability in the returns. Although we said that leverage has the potential to increase shareholder value, we will see that based on the capital structure theory, sometimes leverage does not matter. In the HTMC example, the market value was still 10 million and the share price stayed the same at $50 even after we introduced the debt. Two Nobel Prize winners, Franco Modigliani and Merton Miller, came up with this theory, which is broken down into two propositions. Proposition 1 emphasizes what happens to the value of the firm. Proposition 2 focuses on the cost of equity and WACC, cost of capital. By now, we all know that the value of the firm depends on future cash flow and the discount rate used to calculate the present value of those cash flows. That discount rate, which is the WACC, incorporates the risk of the firm, the risk of those cash flows in the form of beta used in the CAPM, which is our cost of equity, and to some extent the risk in the cost of debt through the yields of the bonds. So the value of the firm will change in two instances. When the value of the future cash flows change, so when the dollar value of cash flow change, or when the discount rate or WACC or risk will change. How do we know the risk will change? Cost of equity will change because beta will change. In general, cost of debt, the yield doesn't vary a lot. So the risk that most comes from beta. The question of capital structure theory is, does it matter that we have debt in the firm? Or if we do have debt, does it matter how much debt is in the firm? Does it matter the debt to equity proportion? The capital structure theory is trying to answer these questions. So the two Modigliani-Miller M&M propositions take on three different scenarios. Each case has its own assumptions, and remember, the aim in each case is to find out what happens to the value of the firm, proposition 1, and what happens to the cost of equity and WACC, proposition 2, when we introduce debt. So in case 1, we look at those two propositions. If there are no costs in the form of no taxes whatsoever, no insolvency costs, no bankruptcy costs. In case 2, we see what happens to the value of the firm and WACC if we introduce corporate taxes. And in case 3, we find out what happens if we introduce insolvency costs on top of corporate taxes. Remember, at all times we're thinking of the capital structure of the firm. Does it matter if we introduce debt financing or leverage in the firm? Does it matter how much proportion of debt is in the firm? Let's look at each case in turn. In case of no taxes, the capital structure theory states that it is irrelevant how much debt and how much equity a firm has. The value of the firm does not change, the assets stay the same, therefore the cash flows do not change. The main point with case 1 is that it doesn't matter how we divide our cash flows from assets between our stockholders and bondholders. The cash flow of the firm doesn't change. In other words, it doesn't matter how much debt and how much equity is. This is proposition 1. What will happen with the cost of equity and WACC? We see that the cost of equity increases because the risk of equity also increases as we raise the financial leverage. However, we observe that WACC is unaffected by the amount of debt in the firm. WACC does not change. How come cost of equity increases but WACC stays the same? Because as we increase the amount of debt, shareholders require a higher rate of return to compensate them for the increased risk in the firm. There is more debt to repay back. The cost of capital will not change because, as we will see in later slides, the change in weights will compensate for the increase in debt and increase in cost of equity. This is proposition 2. Since the cash flow don't change and we haven't changed the discount rate for our firm cash flows, the value of the firm won't change. These are the equation of case 1 with no taxes. So we say that the value of the firm with debt equals the value of the firm without debt. We calculate this value as earnings divided by the required rate of return of assets. In the same way, we value a perpetuity. We know that the WACC is the required return of the firm's overall assets, financed with both equity and debt, and we change the notation to RA, return on assets. This is the same equation as in the last module, the unadjusted WACC. Rearranging that equation, we isolate the cost of equity, RLE, the cost of levered equity, to show that it depends on RA, the required return on firm's assets, RD, the cost of debt, and the debt to equity ratio. So the cost of levered equity depends on the firm's business risk, the day-to-day running operation, and depends on the firm's financial risk, the amount of debt of leverage the firm has. Also, note that if the firm is financed only with equity, the required return of assets is just the cost of equity. As it was said on the previous slide, the important point to remember is that although the cost of equity raises with increasing the debt, WACC or RA stays the same. The expected return on a levered equity, company's equity, RLE, is a linear function of the company's debt to equity ratio. Let's look again at our HTMC example and apply case 1 with no taxes. First, proposition 1. What is the firm value? Looking back at slide 29, we see that if EBIT, earning before interest and tax, is expected to be 1 million and return on assets is 10%, then value is the same at 10 million whether we have debt or not. For HTMC, under the all equity scenario, the cash flow to equity holder is 1 million. The value of the company, assuming a perpetuity, is 1 million divided by 10%, equal 10 million. The value of the company's equity is its net income of 700,000 divided by 14%, equal 5 million. The value of the debt is the cash flow to debt holders of $300,000 divided by this discount rate, the 6% cost of debt, again 5 million. Therefore, the value of the levered company is 5 million equity plus 5 million debt, or 10,000, the same value as the unlevered company. Now, proposition 2. What happens to the cost of equity and WACC? With no debt, cost of equity is the cost of assets, as the firm is financed with equity only. When we introduced 50% debt, the shareholders require a higher return to compensate them for the risk that now the firm has leverage. Debt to equity ratio becomes 1. Cost of debt is 6, and return of levered equity is 14%. What about WACC? Note that now the proportions have changed and the cost of equity has changed. So we calculate again WACC to show that it has remained the same value at 10%. This is the graphical representation of proposition 1, firm value. In the absence of taxes, capital structure is irrelevant. Whether we have 100% equity or whether we have 50% debt, 50% equity, the value of the firm, the size of the pie, is unchanged. And this is the graphical representation of proposition 2. On this graph, we have cost of capital, or the required return, on the vertical axis, and the debt to equity ratio on the horizontal axis. As a firm takes on more debt, the debt to equity ratio increases, and also the return on levered equity increases. But RA, the cost of assets, stays the same because the weights change. RA, or WACC, stays the same because the increase in the cost of equity is offset by the changing weights. Thus, if the discount rate of the firm's cash flows hasn't changed, we conclude that the capital structure is irrelevant. Now we move on to the second case of M&M capital structure theory. Now we introduce taxes. As soon as we introduce taxes, we know that if we have debt, our cash flows will change because the interest on that debt is tax deductible. By reducing our tax liability, we increase our cash flows and hence alter the value of the firm. We will see that the cash flows will increase by an amount equal to what we call the present value of interest tax shield. Let's look at an example. We follow the same HTMC company where EBIT is 1 million and debt is 5 million. Now we have taxes of 35%. On the left column, we have the mini income statement and the cash flow calculation of HTMC with no debt, the unlevered firm. We call it VU. On the right-hand column, we have the information on the levered firm. We call it VL. Comparing the cash flows of the two firms, we see that the levered firm, the one with debt, has the largest amount of cash flow because they pay less tax. This tax saving of $105,000 is called the tax shield. If the firm were to have the same cash flows forever, they would have the same tax shield forever. What would be the present value of this perpetual tax saving? Applying the perpetuity formula, the answer is given as 1.7575 million, which is the same as the value of the debt, 5 million, multiplied by the tax rate of 35%. What will happen to the value of HTMC now that we have taxes? What about the cost of equity and its WACC? Using the data from the two columns in the previous table, first we calculate the value of the unlevered firm. The equation is the same, we only adjust for tax the earnings, as we are concerned with discounting the after-tax cash flows. And here is the difference. The value of the levered firm is equal to the value of the unlevered firm plus the present value of the tax shield. So the value of the unlevered firm is after tax EBIT divided by 10%, 6.5 million. Therefore, the value of the unlevered firm is 6.5 million plus the present value of the interest tax shield, or the 5 million debt multiplied by the 35% tax. By having debt and taxes, the company increases in value. What about the cost of equity and WACC? For the unlevered firm, adding taxes will not change the shareholders' return, because debt to equity is zero, and because of that the whole term that is multiplied by zero becomes zero. Since the firm is financed with equity only, the cost of capital is the cost of equity. RE is RA at 10%. Once we change the capital structure and add leverage, the firm cost of levered equity increases for the same reasons as before. More risk, therefore additional compensation to the shareholders. The other difference here is that WACC starts to decrease. Through the tax adjustment, we effectively lower the cost of debt as well, making our overall discount rate lower. Linking this result with proposition 1, we see that yes, the value of the firm increases because the discount rate, the cost of capital, the WACC, decreases. By having debt and taxes, not only we decrease our cost of capital, but also we increase our cash flows. That's why the value of the firm increases overall. This is again the graphical representation of proposition 1, the firm value. With a corporate income tax, a proportion of the company's cash flows goes to the government, reducing the value of claims held by equity holders. However, if we have debt and taxes, the government's slice of the pie shrinks because the government allows a deduction for interest payments. The more debt we have, the less taxes we pay, the higher the tax shield is. A company could shelter nearly all of its cash flows by financing its operations almost entirely with debt. Therefore, capital structure matters because company value is larger if the company uses more debt. The implication of case 2 with taxes is that companies should use 100% leverage. However, this is not what is observed in the market. One reason is that debt increases the chance of financial distress and insolvency. And the other reason is that personal taxes can cancel out some of the tax shield benefits to the company. In 1977, Miller developed this model that included both corporate taxes and personal taxes in order to calculate the gain from leverage, GL. This is the general formulation. It includes a no-tax model as special case where the bracket then becomes 0 and GL is 0. And also it includes where only corporate taxes apply. Then the GL will be just the tax shield, as in previous slides. In this table, there are some examples of the model with different tax regimes and values for corporate and personal taxes and the gains from leverage calculated. If there are no corporate taxes, as shown in the last two lines, our case 1 applies. Capital structure, the choice between debt and equity financing is irrelevant. We're indifferent between debt and equity. We observe that gain from leverage is positive only when there is corporate tax and no tax on personal income at all, or when we have corporate taxes and personal taxes on dividends only. And we observe that the gain from leverage is negative when personal taxes on income from debt is quite high. In the other two cases, the combined personal taxes offsets the gain from tax shield and the gain from leverage is zero. We said that one of the reasons firms don't use 100% debt is that it increases the probability of insolvency. Insolvency occurs when the firm has difficulty paying its debt obligations. A firm will become insolvent, or to use the term used in America, bankrupt, when the value of the assets equal the value of liabilities, and then the value of the equity becomes zero. Shareholders lose all their money. There is no equity left. When this happens, the creditors or bondholders take over the assets of the firm because that's exactly what they are owed, and they expect to be paid back what they lent to the firm. These are some of the factors that influence the chance of insolvency. Not having enough cash flows, the interest payable is too high, mismatched borrowing or funding long-term assets with short-term debt, and overinvestment in accounts payable and inventories. In every firm, the level of debt is beneficial up to a point, after which the cost of insolvency offsets the benefit from the tax shield. And because of these insolvency costs, as we add more debt beyond our optimal level, the value of the firm will decrease and the cost of capital will increase. This is also known as the trade-off model or the static theory of capital structure. The firm will borrow up to a point where the gain from the tax shield on debt offsets the cost of insolvency and financial distress. In this model, it is the cost of becoming insolvent that matter in the capital structure decision rather than the possibility of insolvency itself. These costs are classified into direct and indirect insolvency costs. Now, when a firm goes bust, it incurs direct costs in the form of legal and administrative costs. These costs would ultimately cause creditors to lose because the assets will be eaten away and they don't get back the full amount owed. To give you an example, Enron spent about $665 million in the first 30 months of bankruptcy on lawyers, accountants, consultants, etc. These huge amounts of costs become a disincentive to debt financing. And then we have indirect bankruptcy costs or insolvency costs, which are the resources spent on avoiding insolvencies. These are difficult to measure because it can come in the form of lost sales, interrupted operations, assets lose value because management is worried about avoiding insolvency instead of running the business, loss of valuable employees, and so forth. How can you put a value on these? Both equity and debt holders don't like when the firm is in financial distress. Shareholders want to avoid a formal insolvency filing. They still want to be in control. On the other hand, bondholders want to keep the existing assets intact so they can at least receive their money back. We call financial distress cost, both the indirect and direct cost, the cost associated with going insolvent and or avoiding insolvency. And because each firm is unique with its own risks and asset structure, industry influences, government regulation, etc., the applicability of capital structure theory in finding the optimal level of capital varies. The greater the chance of insolvency, other things being equal, the less debt will a firm hold. Only firms with large tax liability will benefit from increased leverage because the tax shield will reduce their tax liability. If a firm has losses, getting more debt won't make a difference. In fact, it will make matters worse. Firms with uncertain earnings also have a high probability of experiencing difficulty paying their bills, even without debt. Adding debt will make matters worse. Because of these, industries with riskier cash flows, like cyclical industries, tend to have lower debt than those with steadier revenues, such as utilities.